Question 1. A registered representative, RR, resigns from a broker-dealer. Which of the following statements regarding the filing of Form U5 is correct? A. The broker-dealer must file the Form U5 within 10 business days of the RR's termination. B. The broker-dealer must file the Form U5 within 30 days of the RR's termination. C. The RR is responsible for filing their own Form U5 directly with FINRA. D. FINRA will automatically generate and file the Form U5 upon notification of resignation. Answer: B. The broker-dealer must file the Form U5 within 30 days of the RR's termination. When a registered person terminates association with a member firm, the firm is obligated to file Form U5 with FINRA within 30 days of the termination date. This form provides essential information about the reasons for termination and helps FINRA track an individual's registration status and history within the securities industry. This timely filing is crucial for maintaining accurate records and ensuring regulatory oversight. Always remember that the firm, not the individual, is responsible for filing the U5. Question 2. Which of the following records must a broker-dealer maintain for a period of 6 years? A. Advertising and sales literature. B. Customer complaints. C. Blotters. D. Copies of confirmations. Answer: C. Blotters. Broker-dealers are required to maintain blotters, which are records of original entry, for a period of 6 years. Blotters capture all transactions on a daily basis, detailing purchases and sales of securities, receipts and disbursements of cash, and other relevant financial activities. This longer retention period, compared to the 3-year requirement for many other records like advertising or confirmations, underscores their importance as primary records of a firm's operations. Keeping accurate blotters is critical for financial transparency and regulatory compliance. Question 3. Under FINRA Rule 4512, which of the following is not required for a new customer account record? A. The customer's legal name and permanent address. B. The customer's social security number or tax identification number. C. The customer's current liquid net worth. D. The customer's occupation and employer. Answer: C. The customer's current liquid net worth. While a customer's liquid net worth might be considered for suitability purposes, FINRA Rule 4512, which outlines the essential information required for new account records, does not specifically mandate its collection as a core element. The rule primarily focuses on identifying information, such as legal name, address, tax ID, occupation, and employment status, to ensure proper identification and compliance with anti-money laundering regulations. Firms must collect information relevant to the account's purpose and suitability, but specific liquid net worth is not a mandated data point for the account record itself. Always remember the fundamental, Know Your Customer, KYC, requirements relate to identification and risk, not necessarily precise financial metrics. Question 4. What is the standard settlement cycle for options trades? A. T+0, same day. B. T+1, next business day. C. T+2, 2 business days after trade date. D. T+3, 3 business days after trade date. Answer: B. T+1, next business day. Options contracts, unlike most equity and corporate bond trades, have a standard settlement cycle of T+1, meaning they settle on the next business day following the trade date. This quicker settlement period applies to both options contracts themselves and the exercise of options where the underlying security is then delivered. Understanding these distinct settlement cycles is vital for operations professionals to ensure timely delivery and receipt of funds and securities. Keep in mind that while equities are typically T+2, options are generally T+1. Question 5. Which regulatory body is primarily responsible for creating rules regarding the municipal securities market, but does not enforce them? A. The Securities and Exchange Commission, SEC. B. The Financial Industry Regulatory Authority, FINRA. C. The Municipal Securities Rulemaking Board, MSRB. D. The Department of the Treasury. Answer: C. The Municipal Securities Rulemaking Board, MSRB. The Municipal Securities Rulemaking Board, MSRB, is the primary self-regulatory organization responsible for developing rules for municipal securities dealers and municipal advisors. However, the MSRB itself does not have enforcement powers. Instead, its rules are enforced by other regulatory bodies such as FINRA for broker-dealers and the SEC for all participants. This unique structure separates rulemaking from enforcement within the municipal bond market. Remember, the MSRB makes the rules, but others enforce them. Question 6. A registered representative receives a written customer complaint alleging unauthorized trading. What is the firm's immediate obligation regarding this complaint? A. The firm must resolve the complaint within 30 days. B. The firm must acknowledge receipt of the complaint in writing to the customer. C. The firm must immediately suspend the registered representative. D. The firm must forward the complaint directly to FINRA for review. Answer: B. The firm must acknowledge receipt of the complaint in writing to the customer. Upon receiving any written customer complaint, a firm's immediate obligation is to promptly acknowledge its receipt in writing to the customer. This ensures the customer knows their complaint has been received and will be addressed. While the firm will then investigate the complaint, maintain records, and potentially report it to FINRA, the initial acknowledgement is a crucial first step in demonstrating responsiveness and compliance. Always prioritize acknowledging customer communications, especially complaints. Question 7. Under what circumstances would a broker-dealer be required to file a suspicious activity report, SAR? A. For any cash transaction exceeding $10,000. B. For any transaction the firm identifies as potentially involving illegal activity, regardless of amount. C. For any transfer of funds between a customer's accounts. D. Only when specifically requested by the Securities and Exchange Commission, SEC. Answer: B. For any transaction the firm identifies as potentially involving illegal activity, regardless of amount. Broker-dealers are obligated to file a suspicious activity report, SAR, with FinCEN, Financial Crimes Enforcement Network, when they identify a transaction or series of transactions that they know, suspect, or have reason to suspect is involved in illegal activity, such as money laundering or terrorist financing. This obligation applies regardless of the dollar amount of the transaction, distinguishing SARs from currency transaction reports, CTRs, which are specifically for cash transactions over $10,000. The focus for SAR is the suspicion of illegal activity. Always be vigilant for red flags that could indicate illicit financial behavior. Question 8. Which of the following is a primary purpose of the Securities Investor Protection Corporation, SIPC? A. To protect customers against market losses in their investment portfolios. B. To protect customers against the failure of a broker-dealer. C. To regulate the securities markets and enforce securities laws. D. To provide investment advice to individual investors. Answer: B. To protect customers against the failure of a broker-dealer. The Securities Investor Protection Corporation, SIPC, was created to protect customers of broker-dealers in the event the firm fails financially, covering up to $500,000 per customer for cash and securities, with a $250,000 limit for cash. SIPC does not protect against market fluctuations or poor investment performance. Its sole purpose is to restore customer assets held by a failed brokerage firm. Think of SIPC as similar to FDIC insurance for banks, safeguarding your accounts if the institution itself goes under. Question 9. A broker-dealer must have its written supervisory procedures, WSPs, reviewed and approved by A. A FINRA examiner during a routine audit. B. An independent third-party compliance consultant annually. C. A general securities principal, Series 24 or equivalent, or another qualified supervisor. D. The firm's chief executive officer, CEO, and board of directors. Answer: C. A general securities principal, Series 24 or equivalent, or another qualified supervisor. A broker-dealer's written supervisory procedures, WSPs, are fundamental to its compliance structure and must be reviewed and approved by a qualified principal, typically a general securities principal, holding a Series 24 registration, or another appropriate supervisor. These procedures detail how the firm supervises the activities of its registered representatives and ensures compliance with securities laws and regulations. This internal approval process is critical for maintaining robust oversight and accountability within the firm. Remember, effective supervision is at the core of a compliant firm. Question 10. When a customer initiates a transfer of their account from one broker-dealer to another, which entity is generally responsible for initiating the transfer request through the Automated Customer Account Transfer Service, ACATS? A. The customer themselves. B. The carrying, delivering, broker-dealer. C. The receiving broker-dealer. D. The Depository Trust and Clearing Corporation, DTCC. Answer: C. The receiving broker-dealer. When a customer wants to transfer their account, the receiving broker-dealer is generally responsible for initiating the transfer request through the Automated Customer Account Transfer Service, ACATS. The customer signs a Transfer Initiation Form, TIF, with the receiving firm, which then submits the request to the carrying, delivering, firm. This system standardizes and streamlines the process of transferring customer accounts between member firms, ensuring efficiency and compliance. Always remember that the firm gaining the business typically kicks off the ACATS process. Question 11. Which of the following best describes the primary role of a broker-dealer's operations department? A. To generate sales and bring in new customer assets. B. To manage the firm's proprietary trading accounts. C. To ensure the accurate and efficient processing of transactions and maintenance of records. D. To provide investment banking services to corporate clients. Answer: C. To ensure the accurate and efficient processing of transactions and maintenance of records. The primary role of a broker-dealer's operations department is to support the back-office functions, ensuring the accurate and efficient processing of securities transactions, handling settlements, maintaining customer records, and managing the firm's books and records. This department is critical for minimizing errors, ensuring compliance with regulations, and facilitating the smooth flow of business. Think of operations as the essential plumbing and infrastructure that makes all other aspects of the business possible. Question 12. A broker-dealer must verify the identity of a new customer account within a reasonable time before or after the account is opened, as required by the Customer Identification Program, CIP, rules. What is the main purpose of CIP? A. To determine the customer's investment objectives and risk tolerance. B. To prevent money laundering and terrorist financing. C. To assess the customer's creditworthiness. D. To ensure the customer is suitable for options trading. Answer: B. To prevent money laundering and terrorist financing. The Customer Identification Program, CIP, is a critical component of a broker-dealer's anti-money laundering, AML, compliance efforts, primarily designed to prevent money laundering and terrorist financing. By requiring firms to verify the identity of each customer opening an account, CIP aims to stop individuals from using the financial system for illicit purposes. While other factors like suitability and creditworthiness are important, CIP's specific focus is on identity verification for financial crime prevention. Always remember, CIP is a key tool in the fight against illegal financial activities. Question 13. Which of the following is not typically considered a red flag for potential money laundering activities? A. A customer making frequent, unexplained wire transfers to high-risk jurisdictions. B. A customer opening an account with an unusually large amount of cash for their stated occupation. C. A customer providing clear and consistent identification documents. D. A customer attempting to avoid currency transaction reporting requirements by making multiple deposits just under the $10,000 threshold. Answer: C. A customer providing clear and consistent identification documents. A customer providing clear and consistent identification documents is an expected and desirable outcome of the Customer Identification Program, CIP, and does not typically indicate potential money laundering. In contrast, actions like frequent transfers to high-risk areas, depositing large amounts of unexplained cash, or structuring transactions to avoid reporting requirements are all classic red flags that should prompt a broker-dealer to file a Suspicious Activity Report, SAR. Always be on the lookout for behavior that deviates from a customer's typical profile or industry norms. Question 14. What is the required retention period for customer account statements? A. 1 year. B. 3 years. C. 5 years. D. 6 years. Answer: D. 6 years. Broker-dealers are required to maintain customer account statements for a period of 6 years. Account statements provide a comprehensive record of all transactions, positions, and activities within a customer's account over a specific period. This longer retention period ensures that a thorough historical record is available for regulatory review, customer inquiries, and potential dispute resolution. Remember that longer retention periods often apply to records that provide a complete picture of customer activity or financial standing. Question 15. In the event of a dispute between a customer and a broker-dealer, which dispute resolution method is often mandated by pre-dispute arbitration agreements signed by the customer? A. Litigation in federal court. B. Mediation. C. Arbitration. D. Non-binding negotiation. Answer: C. Arbitration. Many broker-dealers include pre-dispute arbitration agreements in their customer account agreements, which mandate that any disputes between the customer and the firm be resolved through arbitration, typically administered by FINRA. This process offers a more streamlined and often less expensive alternative to traditional litigation in court, with an arbitrator or panel making a binding decision. It is crucial for operations professionals to understand this common dispute resolution mechanism. Remember, arbitration is often the required path for resolving customer-firm disagreements. Question 16. A registered representative receives an email from a customer requesting a transfer of funds to a third-party account. What is the most appropriate action for the firm's operations department to take? A. Process the transfer immediately, as it is a customer request. B. Inform the customer that email requests are not valid for fund transfers. C. Contact the customer directly via a pre-established, verified method, e.g., phone call to a known number, to confirm the request. D. Forward the email to FINRA for review of potential fraud. Answer: C. Contact the customer directly via a pre-established, verified method, e.g., phone call to a known number, to confirm the request. When a customer requests a transfer of funds, especially to a third-party account, via an unverified method like email, the operations department must contact the customer directly through a pre-established, verified method, such as a phone call to a known home or work number, to confirm the authenticity of the request. This step is critical for preventing fraudulent transfers and protecting customer assets, as emails can be easily compromised. Never rely solely on email for sensitive instructions without independent verification. Question 17. Which of the following best describes the purpose of a principal transaction in a broker-dealer's operations? A. A transaction where the broker-dealer acts as an agent, facilitating a trade between two customers. B. A transaction where the broker-dealer buys or sells securities from its own inventory to or from a customer. C. A transaction involving only municipal bonds. D. A transaction executed on a principal exchange, like the NYSE. Answer: B. A transaction where the broker-dealer buys or sells securities from its own inventory to or from a customer. A principal transaction occurs when a broker-dealer acts as a dealer, buying or selling securities for its own account, from its inventory, to or from a customer. In this role, the firm takes on market risk and typically charges a markup or markdown, rather than a commission. This differs from an agency transaction, where the firm acts as a broker, facilitating a trade between two other parties for a commission. Understanding the distinction is vital for proper execution, disclosure, and record-keeping. Question 18. Under FINRA rules, what is the maximum time period a broker-dealer may hold a customer's mail, e.g., account statements, confirmations, if the customer is traveling? A. 30 days. B. 1 month. C. 2 consecutive months. D. 3 consecutive months. Answer: D. 3 consecutive months. FINRA rules permit a broker-dealer to hold a customer's mail, such as account statements and confirmations, for up to 3 consecutive months if the customer is traveling, provided the customer provides written instructions and a valid reason. If the customer is not traveling, mail may be held for an even longer period, e.g., for valid reasons like health or safety, but firms must also ensure alternative methods for customers to access their account information. This rule balances customer convenience with the need for timely delivery of important account documents. Question 19. If a broker-dealer has custody of customer funds or securities, which regulatory rule set becomes particularly relevant and stringent? A. Regulation NMS. B. FINRA Rule 2210, Communications with the Public. C. SEC Rule 15C3-3, Customer Protection Rule. D. FINRA Rule 4210, Margin Requirements. Answer: C. SEC Rule 15C3-3, Customer Protection Rule. When a broker-dealer has custody of customer funds or securities, SEC Rule 15C3-3, also known as the Customer Protection Rule, becomes highly relevant and imposes stringent requirements. This rule mandates that firms maintain possession or control of customer securities and segregate customer funds from firm funds to protect customer assets in the event of the firm's insolvency. Compliance with this rule is a critical aspect of financial operations for firms that hold customer assets. Always remember that holding customer assets comes with significant regulatory responsibilities. Question 20. What is the primary purpose of a buy-in process in securities operations? A. To cover a short sale that has gone against the investor. B. To settle a failed delivery of securities by requiring the selling broker to purchase the securities in the open market. C. To execute a market order at the best available price. D. To facilitate the transfer of securities between custodians. Answer: B. To settle a failed delivery of securities by requiring the selling broker to purchase the securities in the open market. A buy-in is a mandatory process initiated when a selling broker-dealer fails to deliver securities to the buying broker-dealer by the settlement date. To resolve this failed delivery and ensure the buyer receives the securities, the buying broker can buy in the securities, meaning they go into the open market and purchase the necessary securities, charging any losses back to the original selling broker. This mechanism ensures timely settlement and prevents disruptions in the market. Understanding buy-ins is key to managing settlement risk. Question 21. Which of the following is required to be disclosed to a customer before the first options trade in their account? A. The Options Disclosure Document, ODD. B. The customer's credit score. C. A comprehensive list of all FINRA disciplinary actions against the firm. D. The firm's proprietary trading strategies. Answer: A. The Options Disclosure Document, ODD. Before a customer can engage in their first options trade, the broker-dealer is required to provide them with the Options Disclosure Document, ODD, also known as the Characteristics and Risks of Standardized Options. This document outlines the complex nature and risks associated with options trading, ensuring customers are adequately informed before participating in this type of trading. Providing the ODD is a critical regulatory requirement for investor protection in the options market. Always make sure customers receive and acknowledge this important document before they begin trading options. Question 22. When a broker-dealer receives an order for a security, which record is updated first to capture the details of the transaction? A. The customer's monthly account statement. B. The firm's general ledger. C. The order ticket or order memorandum. D. The confirmation statement sent to the customer. Answer: C. The order ticket or order memorandum. When a broker-dealer receives an order, the very first record created is the order ticket, also known as an order memorandum. This document captures all essential details of the order, such as the type of order, buy, sell, quantity, security, price limitations, and account number, before it is routed for execution. This initial record keeping is critical for accuracy, compliance, and audit trails. The order ticket serves as the foundational record from which other records, like confirmations and ledger entries, are derived. Question 23. What is the primary purpose of a broker-dealer's net capital rule? A. To ensure the firm generates a consistent profit. B. To protect customer assets by ensuring the firm has sufficient liquid assets. C. To limit the amount of margin a customer can borrow. D. To dictate the commissions a firm can charge customers. Answer: B. To protect customer assets by ensuring the firm has sufficient liquid assets. The SEC's Net Capital Rule, Rule 15C3-1, is a critical financial responsibility rule designed to protect customers by ensuring that broker-dealers maintain sufficient liquid assets to meet their current obligations. It acts as a safety net, requiring firms to have a minimum amount of readily available capital above their liabilities, thus reducing the risk of insolvency and safeguarding customer funds and securities. This rule is a cornerstone of investor protection in the securities industry. Remember, net capital requirements are all about ensuring firms have enough cash to withstand financial pressures. Question 24. A customer dies, leaving an individually owned account. Which of the following documents is most crucial for the broker-dealer's operations department to obtain before processing any transfer of assets? A. A new account application from the beneficiary. B. A notarized copy of the customer's last will and testament. C. A certified copy of the death certificate and proper legal documentation, e.g., letters testamentary. D. A verbal instruction from the customer's attorney. Answer: C. A certified copy of the death certificate and proper legal documentation, e.g., letters testamentary. When an individually owned account holder dies, the broker-dealer's operations department must obtain a certified copy of the death certificate and appropriate legal documentation, such as letters testamentary, if there's a will and an executor is appointed, or letters of administration, if there's no will and an administrator is appointed by the court. These documents legally authorize the transfer of assets to the rightful beneficiaries or estate, ensuring proper legal due diligence and preventing unauthorized distributions. Always ensure all legal paperwork is in order before moving assets from a deceased individual's account. Question 25. Which FINRA rule prohibits broker-dealers from misusing customer securities and funds? A. FINRA Rule 2090, Know Your Customer. B. FINRA Rule 2150, Safeguarding Customer Funds and Securities. C. FINRA Rule 2210, Communications with the Public. D. FINRA Rule 3110, Supervision. Answer: B. FINRA Rule 2150, Safeguarding Customer Funds and Securities. FINRA Rule 2150, titled Safeguarding Customer Funds and Securities, specifically prohibits broker-dealers from making improper use of customer funds or securities. This rule reinforces the fundamental principle that customer assets must be protected and kept separate from the firm's own assets, preventing commingling and unauthorized appropriation. Adherence to this rule is paramount for maintaining investor trust and financial integrity within the securities industry. This rule is central to ensuring firms act as fiduciaries with customer assets.